Welcome to the Legacy Leaders Podcast. Are you doing the best for your client to help them create their legacy? Are you creating a plan that goes far beyond finances to help people ensure that it becomes the driving force behind all decisions? On this podcast, hosts Katie Beth Hand and Stan Miller will help you with growing your practice and your client's peace of mind. Together, they bring the best and brightest minds to share with you how to help your clients develop their best legacy. And now, here are your hosts, Katie Beth and Stan.
Welcome back to the Legacy Leaders Podcast with your hosts, Stan Miller and Katie Beth Hand. Our guest today is a formal financial executive who teaches people how to use their current debts and expenses to grow their wealth outside of the traditional approaches. Dr. Robert Scranton has been able to help people all over the United States take advantage of the infinite banking concept. So, Dr. Rob, welcome to the show. Stan and I are so excited to be with you today.
Yeah, thank you guys for having me on. I look forward to it too.
Perfect. So, I always, before we dive in and Stan and I hit you with a bunch of questions, I would love it if you would take just a couple of minutes and tell our listeners a little bit about your background, your backstory. We talked a little bit about that before we ever hit record today, but tell us a little bit about your background and kind of what made you fall into or get into this career path that has led you where you are today.
Yeah, absolutely. So I graduated from University of Illinois in Champaign-Urbana with a degree in accounting and finance, and moved up to Chicago and worked for a CPA firm preparing tax returns, doing audits for large corporations and wealthy people. Eventually became a financial analyst for the Florsheim Shoe Company, if anybody out there's ever heard of that before. And I was, living my life and doing what most people are doing as the plan administrator. Came down for our company to talk to us about our 401k options and IRAs and stuffing money in there, and doing that for a good number of years. And then this 2008, 2009 housing bubble crisis came along. I don't know if anybody else had any unusual or unhappy experiences around that, but I would usually pay attention to my statement when it would come every quarter, and all of a sudden one quarter, I'm like, oh, they must have got me mixed up with somebody else because half my money's missing. And my portfolio had dropped by 45% in 3 months. And I had no idea, wasn't paying any attention to it. And I called my financial advisor. I said, hey, is this right? Or what's going on here? He says, yeah, unfortunately, the market's taken a turn for the worse. And I said, well, why didn't you take me out of it so that didn't happen? You're the financial professional. And he, did a lot of jumping around and song and dance and tried to explain himself away. But I was just very frustrated by that. I'm like, my goodness, what if this had been the year I retired, when I no longer had a job or no longer had an income or didn't have enough life left to make up the deficit? Thankfully, I was young enough. And so this kind of started my journey of looking at what other alternatives there were, because I didn't want to ever go through that experience ever again. And I didn't like the idea even that I was just giving my money to somebody else and trusting that they were going to take care of it. And I wanted to have more control and dominion over my own money and my own finances and have more control over it. And I'd worked at a CPA firm that one of our main goals was to reduce people's taxes, but not just their taxes on an emergency basis, but kind of long-term financial tax strategy and planning, how to avoid paying any more than the government demands that we have to over the course of our lifetime. And I came across this thing called the infinite banking concept, and it was just so intriguing to me to create my own banking system, as they were explaining to me that the fact that the average American will spend 35% of all their earnings over the course of their entire life paying interest payments to third parties and watching that money disappear and leak out and leave their life forever. Well, what if I could create my own banking system where I could recapture, recycle, and reuse those same dollars over and over and over again, and have them stay inside my family financial pool of money rather than leaking and disappearing to somebody else? If I could keep 35% that I'm going to lose otherwise, I wouldn't necessarily have to work 30% harder to make the same amount of money. But at first, as I was learning all these things, that like, wait a minute, I can earn here and use my own money And while I'm still earning and never stop the compounding and growth in this money, I can use it to invest somewhere else or pay off debts and save the interest. And I can literally earn an interest rate on the same dollar in two different places at the same time. And it's not just a theory or a belief, because I thought this just sounds too good to be true. Why, with my financial education and background and work experience, why have I never heard of this before? And so I became the ultimate skeptic, kind of like the Saul from the Bible persecuting the infinite banking concept. But as I studied it, realized that absolutely everything they're saying is completely true, 100% accurate. And I turned from Saul the persecutor to the Paul the evangelist, telling everybody I possibly could over the last 15 years about this concept that I believe everybody would be doing it, except that most people have never heard of it. And even the people that have heard of it don't truly understand it. But I really, truly believe everybody should be in two businesses in their life, at least. Whatever business it is that they earn their income and their wage to pay their bills, and that they should also be in the banking business for themselves and their family and their future and their legacy long term to pass down generational wealth. So that might have been more than I was allotted time wise, but that's as short a synopsis as I could put together there.
No, that was a great explanation. I love the idea of this, and I love kind of the backstory of how you got into it, and laughed a little bit. On your website, it even says that when you first learned about it, you figured this had to be illegal. And so, that kind of is what being this skeptic and being the Saul and going through and being like, this can't be right, or this would be something everyone would do. So I guess my question for all of the people listening who may not know much about this concept or may not have really heard about it at all, kind of where do you start? How much money do you need to start something like this? Do you already have to be wealthy to jump into something like this? Where is kind of a jumping off point where you can get started doing this for yourself?
Yeah, my belief system is to learn how to use the infinite banking system for yourself and to be able to teach your children. And like I said, keep that generational wealth, keep the money in the family so it doesn't leak and disappear, because most of the financial systems out there are set up to benefit a lot of people, but not the average everyday consumer. And so even if you start small, I tell people start where you're at so you can grow and get to where you want. I mean, I started with, I think, $800 a month or $200 a week or something when I first started this 15 years ago. But then as I got promotions and I got raises, I started increasing the size of my banking system. For some people, it could start for maybe a good average or a good way of thinking about it. If you could commit to 10 times your age on a monthly basis to creating your own banking system. And for some people, it may just be a matter of redirecting. If they're already saving $500 a month into a savings account, they could just redirect that, into their own savings account and creating their own banking system where the money's going to grow and accumulate and compound tax-free inside that bank. And it's just as liquid and accessible as it is at Wells Fargo. The problem with Wells Fargo is you earn almost nothing, and of the nothing you earn with it sitting in there, you're still going to have to pay taxes on it. It's still extremely exposed. It's considered part of your wealth, whereas any money you get into your own privatized banking system doesn't even show up anywhere. It's not even considered part of your wealth. And as a result of that, it's not going to be subject to judgments, liens, IRS decisions, lawsuits like it would if it was sitting in your Wells Fargo account. It's completely protected from all those types of attempts at confiscation or legalized theft, as I like to call it.
Legalized theft. I love that. Does taking loans from kind of your own banking system in this way, does it affect your credit score one way or another?
Doesn't impact your credit score at all. It doesn't show up anywhere. I mean, legally, it's your money. One of the instruments, and I always tell people, this is just the product that we use for the process, the infinite banking system. If we could use a lawn chair for the infinite banking system, we would use a lawn chair. It just so happens that the financial instrument with the features and benefits necessary to make this infinite banking system work just happened to be an overfunded, whole life insurance policy with a mutual company that pays dividends. And because of that, yes, when we borrow, and Kathy, remind me your question again so I don't get going too far on a tangent again, make sure I'm addressing what you
No, no,
asked.
no, no. You're great. My question was it was just, does it affect the credit score? And you assured me it does not because
Okay,
it's nowhere in the system. Yeah,
right. I was getting there when I wanted to make sure I didn't go off in a different
you're
direction
good. No,
than
you're
what you're
good.
saying. So thanks for bringing me back in with that. But so yeah, it doesn't affect your credit scores because when you take loans, you're just borrowing from the cash value that's built up inside the policy in your own life insurance policy. And so you don't have to go to any credit bureaus. You don't have to fill out any paperwork. The insurance company will make you a loan because they're already indemnified because of the cash value inside the policy. They're always going to be made whole because if you don't pay back that loan, they just subtract that amount from the eventual death benefit that they're going to pay out at some point in the future when you pass away. So no credit bureaus involved, no paperwork involved. All it takes is a phone call to the insurance company, say, hey, I would like this much money up to the full value of the cash value inside the policy at any given particular time. So yeah, no hard hits on your credit. You could have horrible credit. You could not have a job anymore. Good luck trying to go get a loan at a bank if any of those situations are going on. But when it comes to having your own banking system, you are the banker. So you're going to make all the decisions about whether you can take a loan, how much you can take, what the repayment terms are, how long, the interest rate, how much, whether you pause during the middle of the loan repayment or ultimately decide just not to pay the loan back at all. Again, good luck doing that with your house or your car. If you stop making payments, they're going to come take your stuff.
Right. Absolutely. Okay, I've stolen all of the questions so far. Stan, what questions do you have for Dr. Rob? I will be quiet for a minute now.
Oh, no, no, you're great. So I do have questions though. So I know that on your website you have a master class. You go into some detail about how this works, but could you just in a few minutes just walk us through the mechanics of how this works? I know there's a whole life insurance policy that's a component of it, but talk about that. Talk about the structure of ownership, because I know you're telling me that the structure also keeps this asset away from like lawsuits and judgment creditors. Just give us let's say we have an elevator ride in a tall building. Take a minute and just walk us through, just in simple terms, how this works.
Yeah. Well, it has some very unique features and benefits that just don't exist with any other financial instrument, on the planet. Because when we are making our premium deposits, and we think of it as a bank, so we call it deposits instead of payments, just for psychological thinking, because a large portion of that is going to be available. And over time, in fact, we'll have far more cash inside the policy than all the premium payments that we've ever made. So sometimes people will throw cold water on this idea and say, oh, no, you should buy term and invest the difference. But that's actually, in the first year, maybe you could say that term insurance is less expensive or is a better value. But if you don't die, all that money is wasted. Whereas with a whole life insurance policy, the policy is meant to go with you for your whole life or be permanent insurance. So after about 10 years, it's basically a free life insurance policy as you're growing and accumulate cash inside the policy that grows and accumulates and compounds tax-free. And the really interesting thing about it, Stan, is it's one of the only times that you use, borrow, or invest money where you literally will never stop the compounding happening, inside the system itself. Because everybody talks about compound interest and everybody has heard of compound interest, but literally nobody out there uses compound interest. Grocery stores don't use compound interest because if they buy the food and they hold on to it for 10 years, is that one loaf going to turn into a second loaf? Or is it all just going to spoil? No, they've got to move that merchandise and that food and keep it coming in the back door and going out the front door at all times. Whereas as we build up cash value inside of our policy and decide, you know what, I have this other investment, this house flipper, for instance, he said he's willing to give me first position on the lien. He's going to flip this house, but he needs capital to acquire it. So he needs my $100,000, but figures he can turn it around in 2 months. He's going to pay me 6% interest to have the use of my capital for those 2 months. So what I do is I go to the insurance company and say, hey, I've got $100,000 in cash value that's built up inside my policy. I would like to borrow that. Well, here's the key is he's not actually taking the money out of the policy. What he's doing is taking a loan from the general fund of the insurance company itself, with the cash value as collateral, and the interest rate the insurance company charges, because they're a mutual company. With a mutual company, we are also owners of the company, so they treat us very nicely, like members of a credit union would treat their members. And they're going to charge us a lower interest to borrow than what they're paying us inside the policy. So we're making a hit there. But the other key is that we never, therefore, because we're not taking the money out of the policy, even while we're borrowing that 100,000, we still are earning, growing, and compounding on that entire 100,000 inside the policy at all times. And in 2 months, that gentleman is going to return our $100,000. We repay that loan to the insurance company, and we've got another $6,000 on top of it. And we never stop the compounding and growth inside the policy itself. Anytime you've ever taken $100,000 out of anything, whether it was a CD, out of your Wells Fargo savings account, as soon as you took that money out to go make that investment, you stop the compounding completely the moment that you do that. Whereas that does not happen with this. So it literally allows us in a completely safe way with no risk at all to earn in two different places at the exact same time. And I would say that's probably the key to what makes this infinite banking system so effective. And it's so unique and unusual. It's hard for most people to wrap their heads around because they just don't have any experience with ever having done that at any other point in their life with anything else they've done. Because as far as I'm aware of, there just isn't any other financial instrument or tool that exists on this planet with those features and benefits. And hey, I'm open to it. If you know of something, please let me know, because I've been looking for the last 14 or 15 years and I just haven't found anything else yet.
Yeah. How do you protect it from creditor claims?
Because legally, the cash value inside your life insurance policy is considered part of the death benefit of the life insurance policy, and they're not part of your assets subject to those types of things. We've had a lot of clients recently that have been working with us, that we've helped set up these banking policies because they're just trying to move their assets from wherever they've got them sitting now into their own protected, privatized banking system. Because in California, it looks like likely Gavin Newsom will probably get his wish and create a wealth tax in California, because I mean, they've got about a $16 billion budget deficit and people are fleeing like crazy, and they're trying to figure out some way to make it up. So a wealth tax would tax you, be a separate and additional tax to everything else that you pay based on all your wealth. So your house, your cars, your retirement account, your toys, anything that you own, there'll be a set tax rate. And as we know, if things happen in California, they tend to spread across the rest of the country. And so any money that we move from Wells Fargo or wherever else we're holding it into a protected situation as cash value inside our whole life insurance policy, because that's, again, legally considered part of the death benefit of the policy, does not fall.
I think that is true in some states. I know it's also not true in every state. And so to get that additional protection, wouldn't you have to put some kind of an irrevocable trust wrapper around it to have that additional benefit?
Yeah, there's like you said, there's a couple of states that doesn't apply to, and we're aware of what the states those are. So yeah, with a little bit of paperwork, we can still accomplish the same thing.
So there's also the issue of estate taxation, right?
Estate taxation?
Yeah, death tax,
Yeah.
the federal estate tax, right? So
right.
So
it's another. Sorry, I was just going to say, yeah, it's another strategy. A lot of people that with a large amount of wealth will look to move that wealth into this kind of system because it passes on to their beneficiaries tax free. Maybe that's where you were going. Maybe it wasn't. I'm sorry if I interrupted.
Well, I think to accomplish that objective, you'd have to have the ownership of it in a trust structure, an irrevocable trust structure. Because if I'm the owner of the policy, even if my state protects those assets from creditor claims, the death benefit's still an estate tax includable asset. So I think I would have to do something else, right, to move it out of my estate for estate tax purposes.
Yeah, I mean, and it's a very simple process to move these policies into a trust or out of a trust.
Right.
Any good, knowledgeable or planning attorney can assist with that. It's a couple pages of paperwork, and we have some that we can suggest or recommend that our members have worked with in the past if people need help with that. But yeah, that's a fairly simple process to change the ownership just about any time you want to, any named entity.
A lot of our listeners are estate planning attorneys who do that as part of what they do for a living. So they're familiar with that.
Yeah.
Right.
Yep.
So are there specific kinds of insurance products that work better? I know you mentioned whole life issued by a mutual company. That's the preferred model here.
Yeah, there's a book written by a gentleman named R. Nelson Nash called Becoming Your Own Banker. And this was kind of the first text, I think, written where all these ideas were put together and kind of coalesced. He founded the Nelson Nash Institute. And the reason this works so well with mutualized insurance companies, because again, with a mutual company, as a policy holder, you're also an owner of the company. And so when the company does well and profits, we participate in the form of dividends, and we can put those back into the policy. And that's what's part of what's growing and accumulating inside the policy in a tax-free environment, doing it that way.
So how old should someone be when they begin to put this strategy together?
Well, we have, I would say half our clients are in their 60s, 60 plus, because they've lived enough life and seen all the things that they've tried to do that haven't worked out over time. And, they are looking for more stability and consistency. But I put a policy on my now 4-year-old when he was 1 month old. So, the factor of time could help grow and build this policy for him over the years. In fact, my 19-year-old doesn't know it yet, but he's leaving for school this fall. And we set up his first policy about 13 or 14 years ago. He's got enough cash value inside his policy that he'll be able to use that and not have to go to Freddie Mae or Fannie Mae or whoever's giving out student loans these days. He'll just be able to borrow from his own banking system and then pay himself back. Hopefully I do a good job teaching him why he would want to do that and continue to utilize that system over the course of his lifetime.
So he can fund his first home purchase with a policy loan from his own life insurance policy.
Ideally, or the way housing prices are going now, at the very least, at least fund the down payment.
Right. Yeah.
Himself.
Right. Yeah.
Through the banking policy that,
right.
We set up very nominally when he was very small, a few $1,000s a month, but over time, now, a decade and a half later, that's got to be some pretty significant dollars that are going in there consistently.
Yeah, so
those dollars are growing cash on cash, 185 to 200% per year every year, and it just gets better and better from there going forward.
Yeah. So talk a little bit about return, though. I heard what you just said, but give me the slightly longer version of that.
Yeah, so it's one of those things you definitely, when you're creating your own banking system, remember, the main idea is we're not worried as much about return, although that becomes significant over time. Because if you're just trying to compare apples to apples, there is no other apple to compare this to. So most people are comparing it apples to oranges on other things they're familiar with or other things that they know about. The internal rate of return on these policies is typically anywhere from 5.5% to 6% historically. But that's just if you're looking at a year one comparison, because the magic is, even though I've bought three cars I have sitting in my garage right now, and we go in this in my free masterclass training. I know you guys said you'll mention to offer to people at the end of this. And I have paid for all 3 of those cars. I've gotten all the money back for all 3 cars, and I've still got the cars sitting out there in my garage. I don't know of your listeners, guys, how many of them have got back any of the money for all the cars that they've bought, driven, owned over the course of their lifetime. But I got all the money back for all 3 of mine, and we show exactly how we do that with this infinite banking system inside that free masterclass training.
So just drill into that. So what do you do when you want to buy a car is you would go borrow the money from the life insurance policy on your life and use those funds to pay for the car. And then instead of making car payments to the lender, you would make car payments back to your own insurance policy, right?
That's exactly right. Yeah. And when I've done that each time, that's what I went and picked out the car I want. I like to buy new. I take care of them really well, and I keep them for 10 or 15 years. And I know how they've been taken care of that way. What I do is go pick out the car I want. I listen to the finance guy and the terms that he's offering, and then write it all down and say, oh, okay, well, thank you. Well, how about if I came in with a check, what would I need to hand you to drive home with the car? And so then I contact the insurance company, ask him for a check in that amount. In 4 or 5 business days, I have it in my hand. I go pay off the car and drive it home. And then I immediately go onto my Wells Fargo account and I set up the same terms that the finance guy was willing to offer me at the car dealership. And so whether it's, say $550 a month, that's whatever percent interest he was offering for 60 months, I just set that up in my bill pay as an auto pay to go back to my loan for the whole life insurance company. And that way I'm treating my bank the same way I would have been willing to treat the bank that I would have been losing that interest to and repaying that. Plus now I'm replenishing the amount available inside my cash value in my policy to purchase the next car. Right. And doing that, like I said, I got all the money back over time, and I still got the cars sitting in the garage in there. So pretty cool system. And we just use cars because almost everybody's had a car. And whenever I ask people, hey, how much of the money have you ever got back for any of the cars you bought, driven, and owned over the course of your lifetime? And usually, of course, people answer, well, none. We can show you how you can get it all back. And would you be interested in, knowing that? And most people are kind of curious, but you could apply that to your charitable giving, your real estate taxes, or most anything else. So we just use a car as an example because most people have owned or driven a car in their lifetime.
So do you have a preference when you raise the hood on that insurance policy and look inside to see how the money inside the policy is being invested? Do you have thoughts about, or do you have preferences about how you advise your clients on how to invest that? Because I know a lot of insurance companies give you a rather wide range of options about the ways you can invest the money inside a policy.
Inside the policy? Oh,
right.
Well, like we said, we stick to mutual companies that are historically very conservative to begin with. And, all the ones we use kind of stick strictly to long-term bonds, some real estate exposure, but they love working with us because, of course, the safest loan they could ever make would be to their own policy, holders, because we want them to succeed. It's our policy. We're unlikely to do things risky, and there's no risk on their part because they're either going to lend the money to us and earn an interest rate. And if we don't pay it back, they'll just subtract it from what they're contractually, required to pay out at some point to us anyways. And so, from that standpoint, that's a extremely useful way to benefit both parties. We're kind of aligned, when we're doing this infinite banking policy for our policies from the insurance company standpoint and from the mutual owner of the company policyholder standpoint as well. We're not doing anything to undermine or slit each other's throats or jump over each other to take advantage of one another.
In a little bit of the time we have remaining, tell us a little about your business. This idea, I gather, has evolved into your business, right? You introduce this to clients, and so tell me how that works.
Yeah, well, so I usually have people, some of the things we've talked about on here have been new to them or really got their ear or grabbed their attention or they're interested or curious. I'll have them go watch that, hour-long masterclass where we talk about everything there is to know in as quick a time frame as we can about the infinite banking concept. And we give them an opportunity to talk to us about their specific situation and strategize around things like you said, what's the minimum, what's the maximum, that we could build our banking system around. And then we believe the most important thing is that we don't just educate clients about the infinite banking concept and help them set up their own banking system and then leave them to their own devices. We believe that's when our work really begins, is once the policy is actually in place. And so we support our clients by helping them build something we call a money multiplier map, where we take their banking system and we talk to them about their debts and expenses or potential investments that they are looking at, and put that into a spreadsheet and talk to them about the way to be most effective and efficient using their banking system, and how to make sure we're always optimizing the cash growth accumulation and compounding inside the policy. And we'll meet with those clients, 2, 3, 4 times a year, especially as they buy things and sell things, because that's going to change that map. And we want to make sure they're optimizing that at all times. And when we work with them for the long term, because one of the things we had found is people came to us that had infinite banking policies already. And sometimes they were designed very poorly. Sometimes they were designed exactly the way we would have done it, or the way Nelson Nash would have recommended it be done. But the people were frozen into inaction because they just didn't have any support or anybody to help them. And it is money after all, and they're afraid to make a mistake. So they end up doing nothing. And we meet them 3 or 4 years on. They've never taken a loan. They've never used their policy for the infinite banking concept even one time. And we really want to make sure that there's somebody there to hold their hand when they go to take out a loan the first time, and when it's time to start paying that loan back, and they feel comfortable and confident doing that. And after 3 or 4 years, they may not need our help anymore, but we still make ourselves available to do that mapping and help them with that, so that they're truly getting the benefits of why they decided this was a good idea and to do this in the first place. So that's something we're really proud of, and as a really high value of ours to be there with the patient. There's the Dr. Rob and me, to be with the client long term, to make sure they're supported and are really utilizing this for their family for the long term.
This is something you do with clients all over the country?
Yeah, I've got licenses in 48 states and clients in every one of those at this point. This is, not every place you go that there's people that specialize in putting these types of policies together. And that's probably the most critical thing, because anybody with a life insurance license can sell you a life insurance policy. And sometimes people will listen to my a podcast like this and be half listening in while they're also doing something else. And they might hear that, oh, well, Dr. Rob said that they use whole life insurance policies for this. So they trot on down to their State Farm agent, say, hey, I'd like a whole life insurance policy. It's not designed properly or correctly. And so that cash value just grows extremely slowly, and because it wasn't designed specifically for the infinite banking concept in the first place when it was first created. And so that's a really important thing, and people are seeking out that kind of help and to make sure they have something that really works for them. And then they tell their sister about us, and she's in Washington and they're in California, and all of a sudden we have this network and web, all over the place.
Right.
Makes sense. That makes sense.
Very interesting.
It is. The whole concept is really interesting. So thank you so much for sharing it with us and with our listeners. Before we have to sign off, is there anything else you'd like our listeners to know? I think a little bit before the show, you mentioned that you might have something special for the listeners of the podcast. So is there anything else you need them to know before we close out today?
Yeah, I would like to offer them a chance to get access to our hour-long masterclass for free at no cost to them. We've opened up on our website a portal for your listeners to get access to that. They can just go to yourfinancialiq.org or yourfinancialiq.org and get access to that hour-long masterclass. And we open up the doors and go over every aspect of, the infinite banking concept. There's probably about 19 really good reasons all by themselves alone why somebody would want to do this. And we cover all of those in that masterclass. And if that makes sense to them, we give them an opportunity to connect with us and maybe talk about their individual specific situation and how this could be applied to their life and their finances as well. So that's probably the best way to learn more and possibly connect on this, and look forward to helping some people take back control of the banking aspect of their life for sure.
That is perfect. Well, thank you so much, Dr. Rob, for being on the show. And for all of our listeners, we want to thank you so much for listening. This has been the Legacy Leaders Podcast with your hosts, Stan Miller and Katie Beth Hand. And our guest today was Dr. Rob Scranton. So to connect with Dr. Rob, like he said, be sure that you visit yourfinancialiq.org and check out that hour-long masterclass. Dr. Rob, thank you so much for just being a part of the show and sharing all of this with us today. And for our listeners, be sure sure to follow him and get connected.
Yeah, that was a lot of fun. Thank you guys so much for having me on.
Great, super. Thank you.
You've been listening to the Legacy Leaders Podcast with Katie Beth Hand and Stan Miller. For more information on them and the show, please visit pinnaclelegacylaw.com. If you like what you've learned today, do share the program with your friends and subscribe wherever podcasts are found.